Well, Happy New Year, Michael. Good to have you back again on the Treasury Talent podcast.
Yeah, you too, Simon. I can't believe it's already the end of January.
I know. Where's that time gone?
I think it's about 7 or 8 weeks since we caught up. So, yeah, it's gone definitely very quickly.
And within that, talk us through what's been happening in the markets. I believe it's been pretty choppy out there and some fluctuation and volatility. Talk us through what you're seeing.
Yeah, there has been. We might start on commodities. They've been most probably the biggest mover, and that sort of got consequences a few different ways. So I guess if we look at iron ore, that's been a pillar of strength, and I think markets have traded above $170. We've seen a bit of a recent pullback of about 8-9%, but iron ore's been much stronger than expected, and that's been one of the key drivers for the Aussie dollar. But food commodities have been incredibly strong. So just running through a few quickly, corn's up over 80% from its lows last year. Soybeans are up about 55. Wheat in the US market is up by about 65%, and raw sugar about 70%. Just some quick examples over the last 6 months. Base metals, likewise, copper has recently hit an 8-year high, which is about what corn and some of the other foods have done. And a lot of it's been, strong Chinese demand, certainly, or in the case of copper, more broad-based in Asia. And copper's also up about 80% from its lows last year. So whilst that's been very positive for the Aussie dollar, there is a potential concern with inflation expectations and longer term inflation, particularly food. Food and metals are both very relevant. So that's something that I think central banks and others will be watching quite closely. And even crude oil is now, it's still below where we started last year, but it's within about 20%. And again, it's a long way off its lows. So I think increasingly central banks will watch sort of commodities and asset price inflation. Things like property has bounced. We had a particularly strong fourth quarter in Australia on property. So, yeah, there's certainly, I think, some things going on that will start to concern central banks if they continue on that inflation risk front. And, I think we certainly need to continue to watch that. Part of the commodity rally also been the weaker US dollar, but that only explains about 10% of it. It certainly doesn't explain the magnitude of some of the moves that we've seen.
What about on the currencies FX side of things? What are you seeing there?
Well, obviously the Aussie dollar's been a beneficiary, as you'd expect, from the rise in commodity prices and the weaker US dollar. So we've seen the Aussie dollar above 78 cents. And you may recall, I think in December, we spoke about people having orders out and flying sort of levels, because you do often get some extreme moves in that thinner Christmas, New Year period. And this year was no exception. So certainly the Aussie dollar had a particularly nice rally into early January. And not just against the US dollar, but some of the cross rates, it's done quite well. And you'd expect that with equity markets hitting record highs in the US earlier in January. So, it's pretty strong global risk appetite, and also that the move we just spoke about in commodity prices. So, the Aussie dollar's done well. And that's another thing I think the RBA will be starting to get a bit more concerned about. Next week will be interesting. We've got the RBA statement, and then I think the Governor Lowe is speaking, I think on Wednesday, and then the testimony is on Friday. So next week will be interesting to see if they refer to the Australian dollar or they make any comment on any potential further quantitative easing. But I guess they've got to balance that against, rising house prices and potential inflation risks. So it'd be very interesting. It'd be a balancing act next week for them, and to see what they say. My view on the Aussie is, I think longer term it still looks pretty positive, providing that the vaccine rollout continues as per expected, and also its effectiveness is as per expectations. And related to that, I guess, is that positive growth sort of forecast continue. I think the Aussie will remain pretty positive. And my view is it's, at this stage, it's hard to see it sub 70 cents unless there's quite a dramatic shift in expectations or risk appetite. It looks very well supported down in the low 70s. But equally, I think anything above 81, 82 would be pretty tough for it. And I think you're going to come up increasingly against the RBA and some other factors. So I think it's still a buy dips. If we see it under 75 cents, it's most probably worth picking some up. But I think once it gets back above 78, it can muddle higher, but I think it's going to be increasingly slower. We won't see that rapid appreciation that we saw the second half of last year.
And what about the bond side of things? What's happening? What's happening there?
Well, the bond market, I guess, is picking up on most probably two things. One, inflation expectations are rising a little bit. And I think in the US, they've risen to about 2%. So when you think about it, are you going to want to buy a 10-year bond at 1% if inflation you think is going to average 2%? Because you're actually losing 1% a year in real terms. So that's sort of one factor, and that's driven the long end of the curve up quite a lot. So if you look at, say, the 10-year US bond rate, that actually traded under 0.5% when the COVID sort of drama hit in sort of March, April last year. But even at the end of July, it was just hovering around or just above 0.5%. It's currently above 1%. So the 10-year bond rate since July, end of July, has actually doubled. Now, people look at it and say, oh, it's only still 1%. That's nothing. And historically, that's right. 1% is the all-time low up until, if we exclude the COVID period last year. But we are seeing, as a result, the steepening of the yield curve. And because the central banks have sort of locked in to the next 3 years of not moving short-term rates and trying to keep the yield curve flatter for longer, it is a nightmare scenario for central banks if higher inflation expectations actually eventuate and become evident in actual numbers. So I think that is a concern for them, as I mentioned, and it's being reflected in the bond market. And you've also got, related to that, we talked about higher commodity prices and higher asset prices, particularly property, but also equities. So I think the central banks were very much watching that longer end of the curve, and I think they'll be certainly hoping that inflation remains very contained, and I think it will in the short term. But as you know, markets are forward-looking, and if they start to price in increased risk of central banks having to raise interest rates earlier than they thought, we'll see a potential further steepening of that curve, and that will have big ramifications for, I think, the Aussie dollar and also equity markets if that eventuates. But that's most probably a risk maybe next year, late this year into next year. I don't think it's a massive risk at the moment.
Definitely. And so what should treasurers out there be keeping their eyes in the next month, do you think?
Oh, well, you know how much I love the share market and how brilliant my forecasts have been in that. But I think you still need to watch that. Just don't listen to what I say about it. But I think the equity markets are still relevant in terms of a barometer of risk appetite. So I think we still need to keep an eye on those. And we've got, obviously in Australia, we haven't made new highs from where we were pre-COVID, whereas the US is up about 10% from those levels. But we've got very high price earnings ratios. So Australia, I think we're about 40 and we're well above 30 in the US. But to be fair, there's been some very supportive economic data coming out in Australia. And we look at consumer sentiment, business confidence and conditions, lower than expected unemployment, and our positive COVID response as a country. there are some justifications for that upbeat sort of mentality and scenario. But I think continue to watch that sort of barometers of risk appetite, things like equities, what's happening with the vaccine and COVID, economic data as always, and I guess any potential changing in wording or clues from central banks around quantitative easing, inflation, exchange rate levels, those sorts of things will be important. I think then there's a few other things. Obviously, Australia-China trade continues to be a risk, and we, I think, need to keep a close eye on that. We've talked about COVID trends and vaccine rollouts and effectiveness, continue to watch. Watch what not just Australian, the RBA do, but global central banks, the Fed in Europe and that, what are they saying and doing? As I said, I think markets will react very swiftly and brutally if they perceive central banks or governments may need to wind back stimuluses earlier than expected. And I guess with a new president in the US, the more global geopolitical risks, what's going to happen with US-China relations, US-Russia, we've got Iran with the nuclear, standoff. What are the US going to do there? They're going to be more proactive, it looks like, on climate change. So that may have some ramifications for certain sectors and growth. And I think Taiwan as a potential flashpoint, continue to watch that closely. So, yeah, there's no shortage of things out there, to be honest.
Well, which explains the volatility, also coming off the shorter time. But
Correct,
Michael,
yeah.
Always a pleasure. Thank you very much for chatting, and I look forward to chatting again next month and seeing where it goes.
Yeah, pleasure, Simon. Thank you.